right, and we are in the house. Welcome to the WeWealth Women podcast. My name is Athena. I am a CPA and founder of WeWealth Women, where we are a community of women for women to help them elevate in wealth and womanhood, right? And today I have our lovely guest, first time on the podcast, real estate agent extraordinaire, mortgage loan officer, Blaine Gardner. Woo-hoo!
Hey, Athena, how are you?
I am lovely. So, full disclosure, Blaine is my brother. Some of you may be wondering because we share the same last name. Blaine is my brother.
Wasn't coincidence.
No, slightly younger, only by what, 2 years?
Years, give or take.
But Blaine is a kick-ass real estate agent and mortgage loan officer. Um, you're like one of the best real estate agents ever, honestly. You are so patient. So patient. I remember you were telling me you had clients, you showed them like 20 houses, and I'm just like, how do you even have the patience to do that? Like, I would want them to buy
Uh,
like the third house.
yeah, different agents take different approaches, but I'm not the person living in that home, so want to make sure it's the right property for that particular client. So I'm not going to decide for them, take them to as many homes as it takes for them to decide themselves.
Do you have a preference? Is it easier to be the mortgage loan officer versus the real estate agent?
It's 100% easier to be the loan officer because the loan officer, I'm most times going to be working from a desk as opposed to being a realtor. On the real estate side, I'm going to be in the field, showing homes or doing appointments and such. But there's a higher compensation on that side as opposed to being on the loan side. But I prefer the loan side to answer your question.
Okay. So you can sell them the house and get the loan for them, correct?
100%. There's no reason to talk to anyone else but Blaine Gardner when it comes to buying a property in South Florida.
Listen, you made it so easy for me to buy my home. It was like the smoothest process ever. So what I want you to do in this episode of the podcast is, a lot of people sat out of the real estate market because they weren't eligible for the homes. Either by the interest rate was too high for them or, what the market prices are. But I wanted you to give an update, especially to our audience, on different aspects of the real estate market currently and different questions that they may have. So the first question, a lot of people, especially in our generation, millennials and below, can't afford homes or don't have homes. Are homes affordable for first-time home buyers?
I would say yes, homes are affordable for first-time home buyers. It's because when you're buying a property, you need to be looking at what is affordable to you. So sometimes you might have to temper expectations in what kind of property you want or may fit your budget. But homes will always be affordable based on your budget, if that makes any sense. So if we're looking to get into the market, and of course, a home might cost, it might be over 2,000 square feet, maybe 2,500 square feet. But that particular property, although it's much bigger, has everything that you need from the extra large kitchen to the, 5 bedrooms, 4 bathrooms, mother-in-law suite, all these different things that a larger home might afford. The price is going to be higher. So there's not necessarily a reason for a first-time home buyer to be seeking a property that's 2,000, 2,500 square feet. That property is going to cost more. So we might need to look at a property that is more affordable, which is going to be smaller and more, aligned with that price range and more aligned with that budget that'll be affordable to you. So it's not about the cost of the home. It's about what your budget is. And then we'll look for a home that meets that budget, where that price is going to be, or that mortgage payment, that expense for the house is going to align with your budget. And that's ultimately what determines the affordability, what you can afford to pay.
So basically, what you're saying is people need to adjust their champagne lifestyle to their bare budget, is what you're saying. Instead
Exactly.
of trying to get a mansion on MTV Cribs, you might have to get like a tin can down the street. Is that what you're saying, Blaine?
Yeah, a tin can, as long as it's your tin can, it's a good tin can, as opposed to
Why is it
renting
still
one.
good? Is it because if you own a home, you can still, even if it's not the best, maybe it's a little, hood adjacent, or up and coming gentrified neighborhood, right? Is it still better to get it because then eventually the equity will increase and you'll have something you can make more moves later down with the equity? Is that why it's still better to get it, even if it may not be your ideal first home?
Yes, real estate is sometimes, a lot of the times, the biggest investment that, or maybe the only investment that some people make. That might not be as versed in other investment avenues or vehicles like stocks and just to name one, but they might end up buying a home. And, depending on how long you own that home, a lot of people buy a particular property and they have the goal of paying that property off and owning it at some point. But during the course of the ownership and making the mortgage payment, of course, the property value appreciates. And
Mhm.
real estate is a much larger dollar amount than opposed to the other investment vehicles. So when you get 5-6% per year on a $300,000 investment, what is that? 5% of 300,000 is 15,000. But 18,000 appreciation for your real estate in 1 year. That's a good chunk of money, a good chunk of equity that you're building each year. So over 10 years, real estate generally points north. There's up and downs, just like any other asset class. There's different things that affect that. But real estate, there's only so much land, and there's only so much. And it also depends on your market. So we're here local to South Florida, the best place in the world to live, in my opinion, and most people will agree with you. Now, South Florida is very limited in terms of the available land that's here. It's very rare that you're gonna see an empty lot that's ready to be built. There might be something there already. So it's very restricted, this area. Of course, we have the beautiful Atlantic Ocean to the east, and then we're gridlocked by the Everglades to the west. It's a very narrow strip of land here, and given all the favorable scenarios and circumstances of Florida, including the weather, economy, and just overall desirability, this particular market even points more north. That long-term trajectory is going to be more vertical or close to it than, say, a more I'm not going to say lesser market, but a less popular market for sure. Say like a smaller town in another state. I'm not going to point anything.
So, all right, for example, I want to ask you a question. Do you think that, say I can only afford a $240,000 home, but I don't want to be in a tin can that is in South Florida. I don't want to be in a tin can area. Would you suggest people move to a state where the homes might be more affordable for them if they really do want, the big bathroom or all different amenities and don't want to sacrifice or skimp on that?
It depends on your circumstance. If your employment might afford you that opportunity to go to another area and then still, have the same job or a better job, um, do you like that place that you're going to? Is the amenities there going to be, realistic for your lifestyle? Do you like to go to the beach? Do you like a lots of restaurant dining options? Do you like museums and many different activities that you can do on any particular day? That's what's here being offered here in South Florida, as opposed to, let's say, another market. I don't want to point any fingers, but there's just so many things here in our area, South Florida, that I would suggest that you stay right here. Um, Maybe you have to get a property that's closer to a area that's not as well liked, or you might not like it, but things get much better over time. And with since the pandemic, there's been a much larger re-interest in Florida, And a lot of people are coming here, and properties are being bought up all cash. They're selling properties, in other states, where real estate is where the markets are much older. So a lot of appreciation has occurred. Let's say in the north eastern states, where you can sell a townhome for, that has 1,500 square feet, and you're selling it for over $1 million. Then you come down here in Florida, and you can buy, at this current time, maybe you buy an acre of land with, 2,000 square feet, and you pay, 600 or 700 for it, depending on where you are. Now that makes a lot more sense.
Yeah.
So, you buy a property, maybe you don't like the area, but I guarantee in 10 years, we're thinking a long-term game here. That area might be completely different than how it is today. And then that property is going to be worth so much more than what you paid for it, because it's just such a desirable and popular place to be down here in South Florida. So I would stay here, and it's all about the location as opposed to the property. You can buy the real estate in a good location or adjacent to one, and just know that if that property is even close to a good location, that the good is going to spread out to where you are in some time. You have to be patient. And that's how real estate is, or any other investment. You buy and you hold. And of course, as long as it's a good asset, and there's real estate in South Florida is a good asset. No one can tell me that otherwise.
So I have a question for you. So you've touched on something that was important, that, for example, because the podcast is obviously global, but we're going to use South Florida as an example. During the pandemic, a lot of people moved here. A lot of people moved here because they had, we don't have any state income tax. Florida was open at the time during the pandemic, so people could have more freedom. Pandemic states like Florida, Texas, Georgia, or states that were open during the time saw this big boom where people moved or relocated from the West or the North, where it was more expensive, came down here, and that drove our inflation, but it also drove up the property prices because people were able to just snatch up the property. Also, coming in the future, I heard Apple and other companies are having locations or headquarters moved here, right? So that's also going to be expected to increase the property value. So if you live in an area where there's going to be expected growth and you actually own a property here, for someone who's looking to be a real estate investor for the first time, what do you recommend? Do you recommend that they sell their current house, take the equity and buy two homes with it? Or do you recommend that they keep the current house and just open up like a HELOC and pull the equity out that way and acquire more property?
Is that for people who are local to this area, or people who are, say, outside of the state?
Local to this area.
Okay. What I'd recommend is I always take an approach of looking at the numbers. And numbers are very absolute, and you can always calculate them and come to a decision very easily, because numbers don't lie. Everyone knows that. So you can always explore. I would hang on to the property, hang on to the property that you have currently. Maybe depending on when you bought it, but say you bought it, even 5 years ago, you probably have a lot of equity that you're sitting on. So I would hang on to the asset and then leverage it through maybe a HELOC or even a cash out refinance. Now, depending on when you bought it, you may have a lower interest rate. So I might not want to disturb that first mortgage. It might be 3, 4, 5% even, whatever. That's still lower than what it is currently.
What is it currently?
Depends on your circumstance, credit score.
What's the range, if you feel?
High 6s to high 7% range. Mm-hmm.
So if your original mortgage is less than that, you say just hold on to it and just get a HELOC. Is that what you're saying, to not disturb that mortgage?
Well, ideally, if you're less than 5%, keep that, because we don't necessarily know when we're going to get back to that level. A lot of people believe that we're going to get there soon, but that's not necessarily the case. I personally believe that interest rates are at a more normal level. When they were much lower, that's not normal, you know. So my personal belief is our rates are going to be between 5 and 7%, just kind of in that range for some time, unless something occurs where then we may have to go below that level to stimulate the economy at that point. But things are going well, are they not?
I mean, they're going well for me because I got my house when it was lower. Even the interest rate I had, I was like, man, I could have just did a little bit nicer, but compared to what they are now,
I
I
know,
was like,
right?
woo, yeah. So the Fed recently cut interest rates, right? And everyone was expecting that to cause, interest on loans, which is a huge factor on the affordability of the house that you can afford and what that total mortgage payment after you factor in property tax and everything else comes out to be.
Of
But I
course.
think you were saying that it didn't lower interest rates. Was that correct? Like the recent Fed rate cut, did it affect? How did that affect the real estate market?
I'll tell you about the most recent Fed cut, which was, I believe, was last week, and they cut it by a 0.25%, correct? So, what has been happening since then is generally people are generally the the Fed the interest rates are going to move over a duration of time, generally in the direction that the Fed is going to be setting. But it's not always instantaneous. So a lot of people figure, okay, the Fed just dropped the rate. They can call my mortgage broker now and say, hey, the Fed just dropped. The rate. Once the rate is much lower, but that hasn't been the case since last week. The rates have been going up, 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 and that's because the mortgage-backed security market is not exactly correlated with what the Federal Reserve is doing. The Federal Reserve is setting the benchmark for what they lend money to banks for. The mortgage-backed security market is a whole separate market, and that has other factors that determine whether that's going up or down. Now, generally, the mortgage rates will follow the Treasury. So a lot of people look at the 30-year T note. That's a much longer duration benchmark to look at. They'll look at the 10-year or the 5-year. I look at all three. And generally, the mortgage-backed security market kind of follows wherever the treasuries are going. So treasuries are going up, then rates are going up as well. And if treasuries are going down, then rates are, generally going to go down with it. So to answer your question, the rates don't always correlate exactly at that time with what the Fed is doing. It has its own mind and personality, but generally over a period of time, it seems to go with what they're doing.
Fascinating, because I hear, or usually the story is, once the Fed cut the rate, that means there's going to be a drop soon, right? But recently in the United States specifically, we had our election, and the new president is going to be Trump in 2025. So President-elect Trump is going to be in office, and what is projected to come under his presidency is that there will be a focus on cutting interest rates across the board to help stimulate the economy, stimulate business, because Trump is pro-business, and to stimulate the real estate market. Do you think that will happen?
We'll have to wait and see. Take that approach. When Fed was selected as the next president, also kind of correlated with when the Fed dropped their rate. And like I said, interest rates have been going up, up, up. Now, the Federal Reserve is appointed by the president, correct? So towards the end of Donald Trump's last tenure, I believe he was he was giving Powell pressure to lower the interest rates, and Powell was not doing so. So there's a belief that Donald Trump is going to try and have the Fed lower the interest rates much quicker. But to my understanding, the Federal Reserve operates independent of the president and other branches of government. They are mandated uh, to to service the public in what they're doing. So I don't think Donald Trump has the or the president, any president really, has the power to influence the interest rate market.
Fascinating, because you know he's been on the internet saying all the things that he plans to do in his presidency, but to hear you say this kind of reminds me of, you know, these politicians makes a lot of promises, but what can actually happen or what they might have the power to do may be limited due to just current law. So now I want you to segue into, this is a channel mostly for women. What should women do to get the best mortgage? Like, what can they do to help themselves? And also, I want to ask you, do you see any unique differences when it comes to women in real estate?
Okay. Well, women can do the following to put themselves in the best position to purchase real estate. Of course, the most important thing in terms of getting the best terms for real estate is going to be number one, your credit score. Okay. The second thing that's going to be the next determinant in the terms is going to be the amount of down payment you're putting down. So if you're putting a minimal down payment, then your terms are going to be, your interest rate is going to be higher. If you're putting more money down, it's less risk to the bank. They're financing less. So they give you a break on the interest rate. Now, this is all going to be predicated on whatever the interest rates are at that time. But the less risk you are to a lender, the better your term. So number one, credit. Number two is down payment. Three is going to be type of transaction, whether you're doing a purchase or, well, this is regarding a purchase, correct?
Yes.
Yes. So credit, down payment, that's give me the largest determinant. So make sure you have a high credit score. It's 720 plus is good because there's different tiers that a bank is going to be looking at. It's not just a specific score that they're going to, 745 and 749. The rate's not going to be that much better for 749 as opposed to 745. There's different tiers and ranges. It might be between 720 to 760, 760 to 800, 800 plus. And the banks, but they're always changing, how they're going to be offering their rate. So sometimes you might price a loan out for 700 credit score, and it's the same rate for someone with a 780 credit score. So they're always adjusting their pricing and adjusting their risk depending on how their books might be, what they have. Maybe they have to sell some loans to get some money back. They're always adjusting it. But generally, the higher the credit score and the higher the down payment is going to put you in the best position to get the best terms. Now, outside of that, you need to be able to support the loan that you're looking to obtain. So we need to increase our income as high as possible, because you don't need great credit to buy a property. You can have, let's say, 500, sub 600 credit and buy whatever home you want as long as you have enough money. So there's different loan products out there that might not even consider your income. But for the best type of financing that we're looking for, which is generally going to be a conventional loan, an FHA loan, or a VA loan if you're a veteran, and the VA loan product is the best type of financing available. So if you're a veteran, you should absolutely own a property. There's no reason why you shouldn't, because you're going to get the best interest rate. You don't have any mortgage insurance, and your down payment, there is no down payment. It's 100% financing for our veterans. Doesn't mean that you can't put it down.
What? Listen, I might need to find a veteran, honey.
Veterans, they've done a lot of work serving their country. So a lot of different benefits go across the board, and housing is not going to be something that they don't get, different benefits for. So yeah, so for the best type of financing, we need to be able to support that loan, and need to have a high enough income to support that mortgage. So
So when
generally, pardon.
so I was gonna segue. So when it comes to women, right?
Mhm.
Do we have different purchasing patterns? Are there things unique to women because that you think we should highlight, and especially since this is a podcast mostly focused on women? Because I read an interesting stat that single women in particular are buying homes at twice the rate of single men. Is that true?
I didn't read that same article, so I cannot confirm nor deny it. I can tell you that women, my experience working with them, and I've worked with a lot of couples as opposed to single women, but women are usually, in terms of the purchase, the determining factor in whether that piece of property will be purchased or not. It's never the husband or the male partner. It's never them. It's always
Why? Why is that?
um happy wife, happy life, you know. So as long as it seems like, and the male is always much more relaxed about the outcome. They're looking for a few different things, but it's usually the lady who is a little more particular, and the person who usually says yes, we want to make an offer there. It's, let me ask my wife what her final decision is. That's from the purchasing aspect. Now, in working with women who are investors, they seem to be more meticulous. They are much more detail oriented. They really care about putting out a very good final product, as opposed to a male investor. I find that sometimes they can be more trying to meet certain timelines and just getting the product out, even beginning to market that particular product before it's even complete. There's nothing wrong with that, because you can start marketing something and with an expected final outcome. But the lady investors that I've worked with, they want everything to be
So
complete,
women care more,
done
basically.
well, and sometimes they even go over the budget. I find for before they invest.
I find it fascinating, and I'm gonna put a little bit of our family biz out there. I remember when dad bought that property and he was fixing it up, right? And I remember I walked in and I looked at the different things that needed to be fixed, and I pointed out it was something with the closet, which he thought was fine. But I walked in and I pointed out the closet and I pointed out two other things, and his dad's comment was like, "Oh, mom said the same thing," but he thought it was fine. But I noticed me and mom walked in, and this is us separately. We didn't walk in together. This is just being a separate run looking. I was like, no, you have to fix this. You can't have nobody move in with this in there. So I find it fascinating. I think there is something to the point where men are fine with like functional things, and women like things to aesthetically also look a certain way, because a lot of the things were aesthetic changes that we wanted to make.
Exactly. A man might overlook certain things, and whereas the woman might, or definitely will not, overlook those things and want it to be addressed. And I do remember, different things with that property that dad was okay with, mom wasn't, and most of those things got taken care of because of mom, right?
Yeah, exactly. So to what you said earlier. So I have a question for you that viewers may be thinking. Say it's their first time buying a property, right? Should they buy an investment home first, or should they buy their I'm gonna live in this home first? Because people always say, like, especially when you have the FHA loan, if you can get multifamily property first at that low interest rate to do that first versus going straight into your single family home for yourself. So I want to ask you that question, which is better?
Depends on the person, depends on their goals, what they plan to do in the next 3 to 5 years, where they plan to be, within that same time frame. Personally, I would say to buy the property where you're going to be living, especially if it's in a good location. Buy the property, own the property. That way you can customize the property and have security in knowing that this is yours. No one's going to ask you to leave after the lease is done. And you can't do this. You can't put that color up, on the wall. And in buying the property, you just immediately get to starting to build easy equity for yourself. You're going to have somewhere that you need to live. Why not have that same place over a period of time, making you some money? So I would say to buy the property that you're going to be living in first, own it, and then from there, start to develop and put yourself in a position to now buy the next property, which will be an investment property. And then to just add on to that, your first property doesn't have to be your final property. You can buy that property, live there for a certain amount of time, and now that place you can leave, declare it as a rental, rent it out, and then move on to your next property, which might be your next primary home. But really, we need to buy a property as soon as possible. That's the moral of the story. Whether you're going to live there first, then rent it out, or just live there, build yourself up, and then buy the next property, which might be the investment property, continue with your current home base, your current homestead.
Why do you suggest buying it as soon as possible?
Once the numbers make sense, we buy it, it's affordable to us, and then we know that real estate will appreciate over time. So we want to get in the market, we want to average into the market. It's like buying a stock. You have a stock that is at this amount, and it's at $50. Maybe the next day it drops to 48, you buy a little more. The next day it's at 52, you buy a little more. But just like you might dollar cost average into a stock, but you can buy so many more stocks as opposed to so many more houses. So people don't really think about it. The same thing applies to a house and real estate. Just the way you would buy portions of stock over a period of time, your dollar cost averaging. You do the same thing for real estate. So if you plan to have any type of real estate portfolio, whether it be 1, 2, or 3 houses, imagine if you have 3 houses paid off in 20 years. That's a very nice, portfolio you can fall back on, when you're not working as much. You can rent it out and you don't have a mortgage there. You worked hard, you paid it off. That rent can take care of your retirement. So just like you would buy portions of other investments, people don't think of it for real estate because it's so much more. The cost of it is so much more. We should take the same approach. So that's why you want to get a property quickly, you get in the market, and then you take it from there and look for the next opportunity, whatever that might be. Does that make sense?
Okay. So we're going to play a little game, and that makes complete sense. All right. So my real estate situation, because you were my realtor.
And your loan officer.
And your loan officer. So that was 2 checks, right?
2 checks straight to the bank.
Your sister gave you 2 checks, honey. Okay, so knowing my current real estate situation, what do you recommend? Do you recommend that I sell this place and get 2 properties from the sale, cash out, refinance, or you recommend I get a HELOC and buy something?
Well, first, we need to find something that you're interested in and then work it out from there and see which one would make more sense, given your goals and the financial aspect as well. So we can't just give something generally. You need to identify an opportunity and then underwrite it and then see what makes more sense. But just off the top, without looking deep. Well, your particular property, you know how I feel about your property.
No, we feel the same way. We feel the same way.
So with your circumstance, and you have so much equity in that property, you could you could um you could sell it and then use a nominal down payment for your next property and make sure that it's still within a price range that the mortgage payment is still going to be well within something that you can afford, and that's not going to stretch what you want to spend on a mortgage payment. And then the difference that you pocket from the net of the sale, we can take that and start looking for other opportunities, in purchasing investment property, whether that's here or another state. I'm a big advocate of buying a property here. Like I really truly believe that everyone should have their primary residence at the very least here in South Florida. That doesn't necessarily mean that you might be able to get your first investment property here in South Florida. Maybe you'll have to go somewhere else.
So quick question. So if I decide that, I move someday, maybe I'm meeting the love of my life, and they live somewhere else, or I just decide, you know what, I want to just live somewhere else outside of Florida. You think that should I ever sell this property, or should I always maintain this property or maintain a property in South Florida, period, and whether it's renting it out or whatever, and buy elsewhere as well? Like, should I always have a property in Florida?
Always have exposure to the South Florida real estate market. So if you're going to sell your current property, start planning on buying another one, whether that's right afterwards, if you find something that works for you, or if you're going to buy something a little down the line. But you need to have exposure to this particular market, because
I think so, because I feel like if I ever sell and don't buy something in South Florida, you might not be able to afford to be in South Florida anymore.
Left behind,
I think you might be priced out in the market.
Exactly. So you always want to keep your exposure to this market by owning a property. A single family home is better. So that would be a good goal.
Yeah, I agree. I think I would probably sell this and buy two properties, one here and another one elsewhere. But that's probably the goal, especially with like the equity available at some point. So, quick question. So, what are programs available for homeowners, especially first-time homeowners, to buy property?
Well, the first-time home buyer incentive privilege is going to be the amount of money that you have to put down for your down payment. So for a first-time home buyer, the lowest amount you can use for a down payment is 3%. That's for a conventional loan. FHA, it's 3.5%. That's the main privilege of a first-time home buyer. Outside of that, you have to put a little more down. For example, for your next property, your minimum down payment will be 5%. And that's if you sell this current property. Well, you don't have to sell it. I'm sorry, but your next property will be 5% down. First-time home buyers between 3 and 3.5, depending on we're going conventional or FHA. And whichever route we take, it just depends on your circumstance. Everybody's a little different. We'll look at both and see which one would make more sense. There's different ways. But conventional, sometimes FHA makes more sense. Just kind of have to see which route to go. Outside of that, there's different municipalities, different cities. Another way to say that might have different programs available for first-time home buyers. Different lenders have different programs, mainly down payment assistance programs and such for first-time home buyers. I don't recommend them most of the time, because most of the time those programs come with a number of different stipulations that might come to give you less flexibility in the future when you're looking to do certain things. Maybe trying to rent the property, can't do it for X amount of years, or you have to pay back this loan or this
Yeah.
down payment, So the best thing to do is just save up. It doesn't take a lot. 3% of 300,000 is 9,000. 3% of 400,000 is 12,000. It doesn't take much to get that minimum down payment to put yourself in position to go buy a property. Outside of that, you have closing costs. There's different ways to get that. Number one, you could continue to save and take care of it on your own. Or maybe you could get a gift from a family member. Maybe you could tap into your 401k. Maybe you can ask a seller of the property to help you pay your closing costs. That might be something that people can start doing now because the current real estate market is a little slower. Properties are starting to stay on the market a little longer as opposed to years past.
So when the seller pays your closing costs, do they just increase the overall cost of the home and then just say, all right, I'm just going to cut you this check for the closing costs?
There's different ways to structure it. Maybe sometimes you have to do that. Maybe you have a price that the seller is asking for, because at the end of the day, you still have to get an appraisal. So the value of the property still has to be in line with what
it's appraised for.
Exactly.
Or you might have to come out of pocket for what the seller wants and the difference between the appraisal.
Exactly. But if the seller's asking a reasonable price, I'm happy below that. Maybe it's realistically worth, $250, and then the seller's asking $235. Maybe you offer them $245, and then they credit back $10,000. So at the end of the day, they get the same net, and they give you back $10,000, which you can put towards your closing costs. But outside of that, you don't always have to do that. Mm-hmm. You're the buyer, you make whatever offer you want. If it's worth $250, they're asking $235, maybe offer $220, and you still ask for 3% back. So that's another route to go for paying your closing costs. In years past, that was unheard of. Sellers weren't paying any closing costs, but right now you could probably make an offer on a property that's listed at X amount and sitting on the market for 4 to 5 days. That seems long these days, right? And maybe ask the seller to give you back 2 or 3%. Never know until you try. So get pre-qualified if you can, if you're interested, and go and try and test the market. Feel it out. It's not really hurting anybody except a little bit of time investment from you and your realtor.
Agreed. So I also want to ask a question. Say I'm a millionaire, right? And I've made my millions working my job. I have some investment in stocks. I have some crypto, but I have no real estate exposure. Like I'm not even really trying to, I've always been scared, or I just really haven't cared about real estate, to be honest with you. Do you recommend, even though someone is successful and has money in different asset classes, to still go and buy real estate as an investment outside of the home that they already own?
I recommend it because you always want to diversify your risk. When certain things are going up, other things might be going down or staying stable. So it's just continuing to diversify and make sure the allocations are reasonable and appropriate. Also, depending on the time of your life and what stage you are in your life, you might have to adjust those different allocations. But real estate should always you should always have some exposure to real estate. If even real estate investment trust, which is not the physical asset, but invest in those companies who purchase real estate and then they pay you back most of the return.
Yeah, they pay about 90%, and they have to, right? That's what I love about REITs.
REITs are great. They do all the managing for you. Of course, I don't necessarily know all the tax implications, but they're just owning the physical asset will have more tax flexibility than, say, having exposure through a REIT. There's so many things that, of course, you can do with real estate and depreciation and so on and so forth. That's very beneficial, to you as the owner. So I recommend, yes, getting some exposure to the asset where the numbers make sense. So I always want to make sure that, the number is acceptable to you and it makes sense to you.
Okay, so for those of us who are listening, you keep saying where the numbers make sense, where the numbers make sense. What do you mean by that? Meaning that after my monthly expense of mortgage and, property tax and insurance and whatever other maintenance, property management, or whatever, this is from a real estate investor standpoint. And then what I'm charging in rent, that net cash flow, like how much, like what do you mean by the numbers make sense? Like how much positive cash flow does it need to be? Or is there a situation where it's fine if if there's a net zero or a slightly negative cash flow if you just really want to own the property?
Um, I would say it depends, but generally, we buy or invest in real estate if it's an investment and this is not your personal residence. If it's an investment, you're buying that real estate to have cash flow. You want it to be positive. You want to have a certain amount. Now that amount will be different, what's acceptable to everyone. But you definitely want to have two, three, four, 500. That's quite a bit. 500. If you're getting 500 a month from, and it depends. It depends on the asset. It could be multifamily, whether it's a single family, what your down payment was. Those numbers are going to vary based on what your expense for the property is. But you definitely want to have a few hundred that you're making on it each month in cash flow. You can't be so marginalized that, we're just breaking even, because real estate is a serious asset that comes at serious costs, and you have to be prepared for those things. And you do so, and you don't want to come out of pocket for it. You want the properties to support itself. And I like to always fall back to what the secondary market defines as a property that can support itself. And by secondary market, I'm referring to Fannie Mae, which is the entity that repurchases, or one of the entities that repurchases the mortgage loans that the different lending institutions write to borrowers. When they run out of money, they sell it to the secondary market, they package it up into a mortgage-backed security, 100 loans, 1,000 loans, 10,000 loans. And then the bank gets back the money for that package of mortgages, and then they can continue to lend those dollars to more mortgages, more consumers. So Fannie Mae, when you get a conventional loan, they don't want the mortgage of the property. I'm sorry, they don't want the rent to exceed more than 75% of what you can rent it for. The mortgage to exceed more than 75% of what you can rent it for. So for round numbers, if you have a mortgage payment that is $750 and the property can rent for, well, to be defined as a property that can support itself by Fannie Mae, the rent needs to be at least $1,000. So the rent is 75%, the mortgage, I'm sorry, is 75% of what it can rent for. So for another example, if a mortgage is $1,500, that property needs to rent for at least $2,000. So the mortgage in this example again is 75%.
And does that include, is just the standalone mortgage of the loan, or the 1,500 is also including like the PMI, home insurance, all of that in it? That final payment.
The total housing expense. So mortgage, which is your principal and interest, and then your taxes and insurance, or whatever other costs, mortgage, insurance, HOA. That expense, a total housing expense, needs to be equal to or less than 75% of what you can rent it for. Now, in that situation, you are able to buy that property and not dip into your own personal income to support the loan. Now, with that threshold, that margin, the property will support itself, and you just put your down payment and your down payment, your closing costs, whatever reserves they might ask you to have in your bank account, and the property will support itself. If it's above that amount, now they will dip into your personal income to meet the difference, and use your personal income as part of the qualifying income. So I like to default to that. So for that, most recent example where I used, where the mortgage was $1,500, the rent was $2,000. You're making $500 a month for that particular property, and $500 a month. I'm not going to complain about that. That is fantastic. For a property I just bought, that's fantastic. Oftentimes it's going to come back less than that, and then guess what? You don't want to buy that property personally. You want the property to be able to support itself without coming into your income.
Right. And then outside of, that $500 a month that you're netting, you can also get, with real estate, you can take depreciation, all these other tax things as well. So that's going to, the decrease in overall tax liability on your personal taxes is also money that you get to keep, basically.
Exactly.
Mm-hmm.
The beautiful thing, real estate. And it's something that most rich people, a lot of rich people got rich through real estate.
Yeah,
And
I think real estate is the biggest percentage. I think 80% of the wealth is through real estate, actually.
Wow. Didn't know.
Mhm.
I knew it was a lot, but 80%, 8 out of 10, 8 out of 10 people. Wow.
Some form of real estate. So, wow, we covered so much. I feel like I just got like a master class in real estate. But I appreciate you so much for coming on the podcast and sharing your knowledge, because you've seen it all. You've had exposure to, residential, commercial. You do you sell the homes, you do the mortgages, so you see all aspects, right? And you see all kind of buyers, people just trying to get their first home, people having multiple homes, people who are just doing it from the investor standpoint. So I just feel so honored for you to come onto the podcast and share all your knowledge.
Absolutely. Welcome, Thea. Thank you for having me on.
Wait. I have one more question. If you were a single woman, right? Because I feel like a lot of single women are very hesitant in nature to buy a property by themselves. From what my experience has been, most women want to buy a property when they're married or they have a partner. Do you recommend women holding out and waiting to get married or have a partner to get their first property? Or if they can't afford a piece of property as a single woman, to still go ahead and do that?
Well, that single woman more than likely is still going to have somewhere to live. And I believe that you should own that property if it's in a good location where you live. So if you can afford it, yes, absolutely buy the property. And not just afford it, if it's well within your budget and you set that budget, don't cross it, and that property does not align with what you want to pay for it and still comfortably live your lifestyle however you want to, don't buy the property. But if it does and you can, I'd say go for it, because why don't we want to start building wealth for ourselves? That's only going to benefit your partner in the future as well, right?
Agreed. Now, before you log off, can you share your final thoughts with our audience and where they can find you?
Yes, absolutely. So I believe on the banner there, you see our website, mylibertyloans.com. If you are seeking a mortgage, feel free to go on there and fill out a loan application, and make sure on the drop-down menu, just select Blaine Gardner, and I'm going to be the person to call you. Otherwise, you can catch me or message me on Instagram. My handle is Blaine, which is exactly how you see it spelled down there, Blaine, BLAINE, MTG. Broker. So Blaine MTG Broker. Feel free to message me on Instagram anytime. And that's probably a good way to reach me.
Fantastic. I appreciate you so much. Thank you so much for coming on the show. Make sure you support Blaine. He's at mylibertyloans.com and at Blaine Mortgage Broker. So are you servicing Florida? Is there a license? Is there any particular limitations? Can you do loans everywhere, or I forgot how real estate works?
I can do mortgages throughout the entire state of Florida. Also Texas, we're licensed there as well. Real estate, I exclusively serve on the South Florida market. So anywhere through St. Lucie, all the way down through Martin, Palm Beach, Broward. I do not go into Miami-Dade County. It's never been my thing. It's a bit of the wild, wild west down there, and I'm not a cowboy. So,
I remember when I was looking for a house and I was looking down there, I was like, man, I would live in a tin can. But back to that tin can example for what they were asking for Miami. And I really feel like Palm Beach is about to be the next Miami with that. Like, I really feel.
Palm Beach is perfect. That's try and get a property here. You have this huge county. There's a spot for you somewhere in it. And it's not quite as wild as, I don't mean to disrespect, and don't take this as disrespect if you're watching from Miami or Miami-Dade. It's just that it's almost a different place down there,
Yeah, and I feel like Palm Beach has more new construction because I see a lot of houses going up too over here.
Mm-hmm. So, thank you for having me, Athena. If anyone has any questions, again, feel free to reach me or direct message me on Instagram there. My handle is right there. And I'll be happy to help you any way that I can.
All right. So that was Blaine, everyone. And he is my brother, but also a kick-ass realtor and mortgage loan officer. And he just gave us a lot of gems, and we appreciate him so much. And thank you guys so much for listening to this podcast episode. I hope we were able to give you so much value and insights. I know a lot of people were interested on home ownership and from buying their first property to what it is to be a real estate investor. If you are new to our channel, new to our podcast, please be sure to like and subscribe. Follow me at WeWealth Women on all social media platforms. And if you need any help, especially as a woman, you can go to WeWealthWomen.com. I have courses on AI Business Launch course, the Goddess Guide to Money, and 2 events coming up as well to help you live your best wealthy goddess life. My name is Athena, and this has been the WeWealth Women podcast.